Okay, so again, scope limitation might occur where the audit client wants to cut down on fees, so they might restrict the auditor from, let's say, doing a physical inventory. They might restrict the auditor from contacting clients concerning the validation of accounts receivable, things like that. Now, should this raise flags, red flags, with the auditor? Absolutely. This should really bring the auditor to question why the audit client is doing so. And again, you have to be skeptical and maybe a little suspicious when things like this occur. The other scope limitation is where, for example, the auditor is hired after the first of the year, and so they can't do a lot of their due diligence. Let's say if they were hired middle of the year or at the first of the year, they could do a lot of their due diligence and audit procedures, let's say up to October 15th for a calendar year audit client. And so all they're doing at the end of the year or after the end of the year is really just catching up for that period, October 15th through December 31st. So there's a lot less work that has to be done. Well, if you're hired after the end of the year, you can't do any of that due diligence. You can't go and do a physical inventory of the audit client at the end of the year because it's too late. You can't confirm receivables at the end of the year. There's a lot of things you just can't do. So, but there might be other ways that you could satisfy yourself that the numbers are still fairly stated. There are alternate ways of doing things. Gap departure. The example they have here, and it's pretty outrageous, where the client wants to use replacement value of assets versus historical cost. Again, that's pretty outrageous. Most companies use GAAP, so that's usually not a problem. But anyway, that would be a reason for having a departure from an unqualified opinion, certainly, and quite frankly, might be a reason for withdrawing from the representation altogether. And then last but not least, an auditor must be independent. If for some reason they find out they're not independent, they're prohibited from issuing an unqualified report. And so they talk about the three options you have here. You can issue a qualified opinion. When you're barred from issuing an unqualified opinion, you can do one of these three things. You can offer a qualified opinion. Now again, when you're issuing a qualified opinion, you're still going to indicate that in your opinion the financial statements are fairly stated. And so, and it's one of these but for type of opinions, but for, let's say, inventories, the rest of the financial statements in the auditor's opinion are fairly stated. So you have a situation here, companies excluded from property and debt in the accompanying balance sheet, certain lease obligations that in the auditor's opinion should be capitalized to conform with GAAP. Here, these lease obligations are known, and so in this case, the auditor can issue an opinion and so here they're saying in the opinion, the qualified opinion, except for the effects of the matter described in the basis for the qualified opinion, the paragraph above, the financial statements referred to present fairly in all material respects the financial position of the company. So again, here they know they can calculate what the effects would be. So as the book points out, the implication is that the auditor's satisfied that the overall financial statements are correctly stated except for this one item. In some cases, you have to, and this is fairly rare that you do this, when the auditor believes the financial statements are not presented fairly in conformity with GAAP, then they have to issue an adverse statement. Usually what happens is, before it gets to this, the auditor will come to the company, the client, and say, hey, unless you do certain things, we're going to have to issue an adverse opinion. And one of two things happens. The client corrects the problem so that the financial statements are presented fairly in conformity with GAAP. The other thing that quite often happens is the client simply terminates their relationship with the auditor at that point and goes and finds a different auditor, or possibly you know, if management of the company and the auditor, the auditing firm, are at loggerheads, at some point the auditor may want to just terminate the client. So adverse opinions, you very rarely see them. And so here you're just saying that the financial statements referred to do not fairly present the financial position of the company in accordance with GAAP. A disclaimer of opinion is where you don't offer an opinion. You simply say you're unable to render an opinion because you are not satisfied that the overall financial statements are fairly presented. And so this can arise when there's a lack of knowledge on the part of the auditor. Back to the limitation of scope. we talked about in the qualified opinion, if you saw that wording on the capitalization of leases, there the auditor was able to estimate a known amount. But what happens, and so because they could determine an amount, it was known. Here, where the scope of the audit, let's say, was done, the auditor was hired after the calendar date of the financial statements, and they are unable to satisfy themselves on the information. So there's a lack of information involved on the part of the auditor. In that case, they certainly can't offer an unqualified opinion, but they can't even offer a disclaimer of opinion. So they have to, or they can render an unqualified opinion. They can't render a qualified opinion because there are unknown amounts involved. Here, their only option is to issue a disclaimer of opinion. And so here you have an example. Except here they're not able to obtain sufficient appropriate evidence to provide a basis for an audit opinion. The basis, same wording as for the qualified opinion, and then you have your disclaimer because of the significance of the matter described. In the basis of disclaimer of opinion, we have not been able to obtain sufficient appropriate evidence to provide a basis for an audit opinion, and accordingly they don't offer one. Note back up at the top the variation in wording. What we saw in unqualified opinions is the wording to the effect that the independent auditor states that we have audited the financial statements of ABC Company. Here, they're restricted from saying that. They have to say something to the effect that they were engaged to audit. So a little bit different wording there. All right. Another thing we need to talk about is how materiality affects audit reporting decisions. And so materiality, again, your opinion is based upon whether or not the financial statements are fairly stated and in all material respects. Okay, so in that phrase, in all material respects, the word material, you're looking at materiality, whether or not there's possibly some misstatements. If they're immaterial, then certainly it's not going to affect the financial statements in any material respect. So you have to look at it, the numbers, whether or not a number is material or not material. And so what determines materiality? Well, materiality is based upon how a misstatement would affect a decision maker's decision. Would the fact that I know this change my decision? If the answer is no, it's not material. If the answer is yes, it's material. And it's usually based on dollar amounts, although there are some instances where just the existence of the transaction might be material, even though it's relatively small in number value. So if an amount is immaterial, you go ahead and issue an unqualified report. If the amounts are material but do not overshadow the financial statements as a whole, you know, what you have to do there, you might have to look at how it affects other parts of the financial statements. If it doesn't, and you know, if it's immaterial, that's one thing. But these next two, let's say the amounts are material but do not overshadow. A good example there is where there's a question about a sale. You have a sale that's made, and they have it listed as being paid, so the amount is listed in cash rather than accounts receivable, even though it hasn't been paid. And so there, you know, you've got an overstatement in cash and an understatement in AR, but current assets is not affected, right? Total assets is not affected. Shareholders' equity is not affected. You know, overall, it's material. Let's say it's $1 million AR that's shown as $1 million in cash. Well, let's say that's material as related to the overall financial statements of the company. But because it doesn't really change the overall makeup of the company, you can still offer an opinion that the financial statements are fairly stated, with maybe an emphasis of the matter. And so there you would offer a qualified opinion, but for this one item that's misstated, the financial statements are fairly stated in accordance with GAAP. Well, what happens where the amounts are so material or so pervasive that the overall fairness of the statements are in question? Well, again, you have to look at materiality, and you have to look at how many components of the financial statements are affected by this misstatement. And so if they're pervasive, what they mean there is that the misstatement affects numerous components of the financial statements. There's a good likelihood that you're going to have to issue either an adverse, well, you're going to have to issue an adverse opinion. You probably wouldn't issue a qualified opinion in that case. Now, the example they give in the book is a substantial sale that is not recorded. You know, you're going to have a lot of different accounts affected by that transaction not being reported. AR, shareholders' equity, net income, revenues, net income, all kinds of things. So in that case, you would issue a disclaimer or adverse. Excuse me, adverse, where it's so pervasive. Last but not least, if you are independent or not independent, regardless of whether or not the financial statements are fairly stated in accordance with GAAP, you have to issue a disclaimer of opinion. So here, where you're dealing with materiality decisions, you've got these choices here. They've got kind of a decision matrix. And so you look at the materiality level. If it's immaterial, your user's decisions are unlikely to be affected, so you can issue an unqualified opinion. If it's material, the user's decisions are likely to be affected, but despite the materiality, the overall presence or presentation of the financial statements are fairly stated, you can issue a qualified opinion. If it's highly material and decisions are likely to be significantly affected, then you have no choice but to issue either a disclaimer or an adverse opinion. And again, adverse is pretty severe and not seen very often. Now again, how do you figure materiality? Usually it's the dollar amount compared with a base. And so an unreported sale of $1 million may be material to a company whose overall asset base is 5 million. But let's say, and let's say revenues are 10. So an unreported sale of 1 million is 1/10 of their overall yearly revenues. So that would probably be material. Nature of the item, that's kind of a big one. What if even though the transactions are small, they're doing illegal stuff? Well, because of the nature of the illegal activity, that may be considered material to the auditor and need to be disclosed and dealt with. And so the conditions requiring a departure from unqualified opinions are where the auditor's scope has been restricted, the statements are not in conformity with GAAP, or the auditor is not independent. So here they have a little decision process Determine whether any condition exists requiring a departure from the standard unqualified report. And so you might look at the amount of materiality involved by either dollar amount or the nature of the transaction or whatever. And then decide on your appropriate type of report, unqualified, qualified, etc., disclaimer, adverse, and then write your audit report. The end.